The chances of living to a ripe old age are pretty high now. But when the basic state pension age was introduced, it was in 1898 by a chap called Otto von Bismarck, who said that in those days the average person could have expected to start work at age 14 and then 51 years later retire at age 65. And how long do you think your average retirement age would have lasted? Well, it was actually 3 years back then. So, can we rely on the state pension? Well, unfortunately, all crystal balls stopped working in 2008. And hopefully, there will be a state pension in the future, but I don't know many people who are relying on it. And that said, despite having a strong belief that it won't be enough, and an equally strong belief that the age you get your state pension will increase, it seems many people are entrusting their future to the retirement fairy. Let's hope she exists. But just in case she doesn't, how are you going to plan for sufficient income in retirement? So the new single-tier pension payable to those retiring after April 2019 will provide a monthly income of £780, assuming the pensioner has a full national insurance record. Those closer to retirement might get slightly more if their entitlement under the old rules was greater than under the new pension rules, but some may get less. Those who haven't paid full contributions or those who've paid reduced contributions because of their work pension. So breaking it down, will £180 a week be enough to live an enjoyable, worry-free retirement? The kind of retirement you'd want after a 40-year working life, yes? So the state pension is going up and up. The proposed increase, which is phased to 68, is expected to sustain the pot for 70 years. But then what? And it's only 4 years ago, as you'll see from the headlines, that reports suggested age 74 was the magic number. Maybe they didn't like that answer, so they asked a different actuary. But let's not be all doom and gloom. Let's take our state pension of £180 per week, payable from 68 at the moment. It's inflation-proofed, it's government-backed, and it has a lot in its favour. But can we really live on it, not just exist? So, we have an idea of how much we might get and when, but most importantly, how much do we actually need? So Laura's going to look at how much we should be putting away in the next session. But if we take the Island's Living Wage Report that was published last year, their research suggests that a single person needs an income of £16,795 a year in order to live a basic life. And looking at the breakdown of costs, it really is a basic life. That means there's a whopping shortfall of £7,435 shortfall if your income's only the state pension. And to highlight the point further, you see the median income figures in comparison to the state pension over the last 20 years, and the gap's getting bigger. And if you have any spare time, you could have a look at this BuzzFeed blog. It's a story of a UK student living for a week on the UK state pension of £155.65 to see what the fuss is all about. Makes for a good story. He makes some classic errors by sacrificing what he really wants, financial security, for what he wants now. He did discover that a week might be just about doable, but when you factor in the luxuries such as haircuts, clothes, birthday presents and holidays, and so on, it was a bit of a struggle. So what else is there? Well, what we can do to plan for retirement, what can we do to plan for the retirement we want? So I'll take you through a quick exercise to just show some context. So for someone's financial life, there are liquid assets in a bucket, let's say. So you've got in that bank and savings. Then you have the illiquid assets, things that you can't just get a hold of quickly, such as your house, perhaps a business, and your pension. They're all illiquid. You can't get those easily. Then you've got your current inflows, which are your salary or your bonus or dividends, which is replaced when you retire by future inflows, state pension, occupational pensions, and so on, which hopefully will last as long as you do. So your bucket should just fill up, shouldn't it? But it doesn't, because you have this hole in your bucket called current expenditure, which when you retire, turns off, and then you've still got retirement income. So in retirement, you have pensions, you have a tax-free cash sum, and you have income coming in. But what else could there be? Perhaps a sale of a house if you downsize, if you sold your business. All those things coming into your bucket. But we don't want our bucket to run out. So my brief tonight extends to quickly look at the types of workplace pensions, auto-enrolments and types of personal pension arrangements. John Walker is going to look at options in retirement later on, but we're looking at the sharp end here, the accumulation, the filling up of the bucket. So the starting place for those in retirement, would be the occupational schemes. There are two types of pensions called DC schemes and DB schemes, defined benefit and defined contribution. So, for example, let's look at the Isle of Man Government Pension Scheme is a DB, or final salary scheme, and the costs of funding that and maintaining that pot have been highly publicised, I'd suggest. Many used to be non-contributory, meaning that the employer paid for everything, but nowadays that doesn't happen. Ultimately, there's a promise by the employer to pay a guaranteed level of benefit in retirement, mainly based on length of service. These schemes have a spouse benefit of typically half if you die, and they're inflation-proofed. But they're also incredibly difficult and expensive for an employer to offer due to the unknown future costs. These days, most are DC schemes, so your contributions are invested, and it's the performance of these investments which determine how much money is available at retirement for you to live on. If you have a pension available at work, it usually makes sense to join it, especially if your employer pays in or even matches your contributions as an incentive for you to pay in. Often there's an option to take extra salary in lieu of contributions, but you think long and hard about this, because a few extra pounds now may seem like a good idea, but a pension, it has the opportunity to grow virtually tax-free. So remember, by what you're having now, you're compromising what you really want, which is a financially safe and secure future, or at least your presence here tonight would suggest that. So other options. What about if you haven't got access to a pension through work? What if you're self-employed? So unlike the UK, the Isle of Man has not introduced auto-enrolment or the compulsory workplace pension. You've probably seen the adverts on TV. It doesn't apply here, alas, which means that you might have to make your own arrangements to set up a pension. A financial advisor, an Isle of Man regulated and insured one, would be able to help you with your options. What's best for you? But let's take a quick look at the main schemes available over here. Personal pensions, normally your big companies like Aviva or Zurich, eventually, I understand. There'll be a limited number of funds where your contributions go. Some may be created with certain retirement dates in mind, reducing the level of risk as you approach retirement, which is known as lifestyling. But charges are often taken directly from the underlying investment funds, and even now it can be tricky to fully understand the total charges. There are also self-invested personal pension schemes, SIPs. There are few restrictions on the investment types that can be held in true SIPs, like commercial property, unauthorised investment funds, but also mainstream investments. Pension member has to pay for trustee services and more hands-on admin, potentially higher charges, but tends to be more cost-efficient for bigger pots. For the master SIP arrangement, there's less admin involved, as it's pooled with other plan holders, but there are fewer investment choices, although still a good range. We also have the Pension Freedom Scheme introduced this year, which work like a SIP, but the rules are slightly different, mainly at retirement though, and I'm glad that's not my job to explain it tonight. Tax relief. So the government does not want you or anyone, any of us, to arrive at retirement and be in poverty. So in order to incentivise you to pay into a pension, there are a number of tax advantages. So for work-based schemes, relief is usually given at source by taking the contribution from your salary before it's deducted. For personal pensions, you typically claim it via a self-assessment form, so tax relief is given at the highest rate that you pay, up to 20%. So put it another way, if you are a 20% taxpayer, you pay in £100, it'll cost you 80. So for any employers in the room, considering setting up a pension for their staff, did you know you can get a national insurance saving on your contribution to the scheme? And this year, the annual allowance was chopped from £300,000 to £50,000. But for most people, that's still sufficient to cover their contributions. But you're limited to your relevant earnings, which means salary and bonus, not dividends typically. An advantage over the UK is that there's no lifetime allowance here, which means there's no tax charge, there's no reason to limit the amount that you save in total in a pension pot, because in the UK there are significant tax penalties for doing that. But finally, investments inside a pension grow virtually tax-free. So, in summary, the state pension is a valuable fallback, a safety net of secure inflation-proofed income, which in most cases will cover the bare essentials. After 40 years of hard work, we probably deserve an enjoyable retirement, but we are responsible to ensure we have sufficient funds to make that possible. The easiest way for policymakers in government to make the state pot last longer is just to increase the age. Again. But it's not realistic to have everyone working into their 70s. What may change in future? I don't know, the crystal ball's broken, remember? It is sensible to plan for a sufficient retirement pot using the state pension to supplement living, rather than the other way around. If you ask your employer for more information on the pension available at work, and if they have a scheme, if they don't, why not? The earlier you start, regardless of what type of pension, the less you need to put away each month to achieve the same size pot when you don't want to be working, or you simply can't. As you can see in the bucket example, there are many other options: savings, investments, bank accounts, building societies, national savings, etc. But having a lifestyle budget is key. You need to live your life now, but have an eye on the future to have peace of mind. How much will you sacrifice for that? Take advice if you're unsure. And remember, life's not a rehearsal.